Have you ever wondered what the secret is to successful investing? The answer may lie within the pages of Benjamin Graham's game-changing book, The Intelligent Investor. This isn't just another investment guide, it's a timeless classic that has shaped the strategies of countless successful investors. It underscores the importance of investing wisely and with a long-term perspective. Today, we'll delve into the key takeaways from this classic investment guide, so buckle up. Benjamin Graham, the father of value investing, penned The Intelligent Investor with one goal in mind: to provide a roadmap for investors to navigate the tumultuous seas of the stock market. This timeless classic has fundamentally shaped the investment world, leaving an indelible impact on countless investors, professionals, and even some of the greats, like Warren Buffett. At the heart of the book lies a keen distinction that Graham makes: the difference between investing and speculating. According to Graham, an investment is a deliberate act, grounded on thorough analysis, ensuring the safety of principal and an adequate return. On the other hand, speculation is akin to gambling, driven by hope, fear, and greed, rather than logic and analysis. The Intelligent Investor is not just a book, it's a philosophy of investing. It encourages the investor to approach the stock market with a rational mind, ignoring market noise and focusing on the intrinsic value of businesses. Now let's break down the core principles Graham laid out in his book. The first principle Graham introduces is the margin of safety. Now what does that mean? Picture this: you're high up on a tightrope. The margin of safety is the net below you. It won't prevent you from falling, but it will cushion your fall, minimizing potential damage. In the context of investing, the margin of safety is the difference between the intrinsic value of a stock and its market price. It's an investment strategy designed to protect against the unknown, the unpredictable, the uncertain. It's about investing in stocks when they are undervalued, offering a safety cushion in case things don't go as planned. Why is this important? Because the stock market is volatile, it's unpredictable. By implementing the margin of safety, you're not just hoping for the best, you're planning for the worst. In essence, the margin of safety is your safety net, your protection against the inherent risks of investing. Next, Graham introduces us to a fascinating character, Mr. Market. This character is a metaphor that personifies the stock market. You see, Mr. Market is a bit of a drama queen. He can be ecstatic one day, offering to sell you shares at sky-high prices, and the very next day, he can be down in the dumps, practically giving away those same shares for peanuts. Graham's genius lies in his advice to not get swept away by Mr. Market's mood swings. He encourages investors to remain rational and not get caught up in the frenzy of the market's irrational behavior. It's like going shopping with a friend who's prone to impulse buying. You don't have to buy just because they're buying, and you don't have to sell just because they're selling. Instead, use Mr. Market's mood swings to your advantage. Buy when he's pessimistic and selling low, and sell when he's overly optimistic and buying high. Remember, Mr. Market is there to serve you, not to guide you. Graham's third principle is the distinction between defensive and enterprising investing. This principle is all about understanding who you are as an investor and making investment decisions that align with your personality and goals. Defensive investors, as the name suggests, are cautious. They prioritize stability and protection of their capital over high returns. This type of investor usually prefers a portfolio that is diversified across various sectors and asset classes, reducing the risk of any one investment significantly impacting their overall financial health. They aim for a steady and consistent income stream rather than the possibility of a big payday. On the flip side, we have enterprising investors. These individuals are willing to take on more risk in the hopes of achieving higher returns. They actively seek out opportunities, diving deep into market research and analysis to identify undervalued assets. While this approach can lead to substantial gains, it's important to remember that it also carries a higher level of risk. So, how do you know which type of investor you are? Reflect on your financial goals, your risk tolerance, and the amount of time and energy you're willing to invest in managing your portfolio. Are you looking for a slow and steady growth, or are you willing to take on the roller coaster ride of more volatile investments? Remember, there's no right or wrong answer. The goal is to align your investing strategy with your personal circumstances and comfort level. Understanding your investing personality can greatly influence your investing success. So, what have we learned from Benjamin Graham's The Intelligent Investor? Let's take a moment to recap and solidify the three crucial principles that have been laid out in this timeless masterpiece of investing wisdom. Firstly, we delved into the concept of the margin of safety. This principle, in essence, is the practice of buying stocks at prices significantly below their calculated value. It's akin to building a safety net beneath your investments, ensuring that even if things don't pan out as planned, you're still protected from catastrophic losses. Remember, the wider the margin, the less the risk. Next, we met a peculiar character by the name of Mr. Market. This allegorical figure represents the volatility and irrationality of the stock market. He's the one who presents you with daily buy and sell offers, which can be absurdly high or low. The key takeaway here is not to be swayed by Mr. Market's mood swings. Instead, use his irrationality to your advantage, buying when prices are low and selling when they are high. Lastly, we discussed the distinction between defensive and enterprising investing. The defensive investor seeks safety and freedom from bother. He wants a respectable return on his investments but doesn't want to spend too much time or effort. On the other hand, the enterprising investor is willing to dedicate time and effort to achieve a better return. Both approaches have their merits, and it's up to you to decide which strategy aligns best with your goals, resources, and temperament. These principles, while simple in theory, require discipline and patience in practice. They serve as a compass, guiding you through the unpredictable seas of the stock market. By adhering to these principles, you can make informed decisions, minimize risk, and maximize potential returns. Armed with these principles, you too can navigate the stock market with confidence and become an intelligent investor. Before we wrap up, we'd like to extend a warm invitation to you. If you found this video helpful and you'd like to continue your journey towards becoming an intelligent investor, don't forget to give this video a like and hit that subscribe button. By doing so, you'll be the first to know when we release our next video. Also, feel free to share this video with others who might benefit from it. Remember, the journey to financial success is often a shared one. Until next time, invest wisely.